2024 started out with a bang. Internet stocks moving. We had crypto moving, earnings that are just absolutely exploding. In the beginning of the first 2 weeks, Bitcoin names, biotech, ITB is U.S. home construction, semiconductors, cloud, IHI, medical devices. But as time went on, things shifted and we started to see new patterns emerging. And that's really important for what we're about to talk to in this video. This video is going to get pretty in depth on how you can spot these patterns and how you can identify them early and get ahead of these sector changes. There in front of you are 39 sectors. And this is how I view the world, always wanting to see where money is going. And then I utilize that to make more informed decisions. For example, you can see right here what is now leading 2 weeks later. We have semiconductors, biotech, home builders, and what is starting to fall down. So this tells us very clearly where order flow is going. We can utilize this when we start looking at the indexes to see what is keeping the indexes up and what is keeping the indexes down. By using certain things such as demarcation lines, we can see what the NASDAQ is outperforming, what the NASDAQ is underperforming. Stay with me. Now, if we just watch this play out for another week or two, you'll start to see when earnings start coming out and saying, okay, what is happening here? And this will take you right into XBI is leading, SOX, Internet, and you're starting to see others emerge. Note where the cues are now. Note what's starting to rally. And then you start seeing these outliers that you haven't seen before. For example, you'll start seeing med devices in here. The pot names all of a sudden are getting very excited and giddy. Certain retail names are developing. You're watching transportations come out of nowhere. This is all important data that you can use to actually track and tell you where to put your money. On top of this, you're seeing some huge moves in the indexes, and we're going to talk about why that's probably going to continue. One indicator that actually has been right since 1955, about 95%, which is staggering. But if we watch this continue to play out, we'll notice a couple things. All of a sudden, you'll start seeing the semis drop. You'll start seeing these internet names move up. You'll start seeing things lift. This tells us again what? Where money is flowing. So by the time we are at February and looking at how this is all going to play out, we're going to notice one distinct thing. The pot names are leading. Home builders are leading. Biotech, no matter how we feel about it during this period of time, is still leading. This is all important data that we can use to make a decision. What we can do then with this data is then drill into it just a little bit more. We can then take a look at this over a 48-hour period and then decide if there's something there that is changing. And we're starting to see a change. Where is that change coming from? Why is this important? It allows you to know the little micro and macro moves on where money is going. Note gold, China names, solar names, the pot stocks going into the week, going into February, these are moving. Why is this important? Because it allows us to make more informed decisions about where money is moving and why it is moving there. And if we can make those decisions and we can follow the money, then we can follow where we're going to put our money as well. This is called edge, and this is where people are losing it. This is what people are not understanding. It's not up for you to decide which one of these is going to move. It's up for you to watch which one is moving and then get involved. Huge difference, and we're going to spend a lot of time on this differentiation today and how you can benefit from that. Hey everybody, welcome back. We're going to start with the basics, just the S&P here. I wanted everybody to understand what I look for in the sectors and how you can differentiate there. We're going to spend a lot of time on differentiation. I made some videos that were a little different this week, and I got some really good feedback, and we're going to discuss that as well. But I want to go through just the basics. It is very hard for anybody on a technical basis to look at this chart and to tell me that it's going down. Now, as we are all aware, there are 3 legs to the stool. This is the market, and this is what affects it: macro, fundamentals, and technical. We have a lot of macro things going on out there right now. You have the war that's going on. You have, are they going to cut rates? Are they not going to cut rates? Or after Friday's non-farm payrolls, are they going to raise rates? Right? We're not going to spend a lot of time on that because we all saw that. But fundamentally, what's going on? 54% of all stocks in the S&P right now are beating earnings by 1 standard deviation. You can say anything you want about this market. You can say it should be going down. It should be going sideways. These are the facts. We have major macro issues that are now unresolved, but bonds are acting really squirrely. We're going to talk about that for a little bit. But technically, let's look at this chart. There is nothing that you're going to look at on that chart right now that is going to tell you, by the way, we're in some serious trouble. And if we sit here and go through just the basic indicators, and that's what we're going to do, just look at some basic indicators here. Take a look at RSI. If you look at RSI on the weekly and people saying, well, it looks like we're going to roll, we're not even back to this peak yet, and we're heading higher. Okay, these were your major peaks on a weekly average, and you're nowhere near that. So for max peak, what you always want to do with these kinds of things, you just kind of want to look for max peak and say, are you anywhere near the max peak that you've seen in, let's just say, a decade, right? On any indicator, whenever you're looking out long term, you want to go out, let's say, a decade, right? So what we would do is just drop a demarcation line and just say, well, here we were up to 95, which is absolutely insane. but here's where we were. And then we can just kind of go through it here. Well, that makes sense too, right? You're not even near that yet. And this is a weekly thing. So we can look at something like that. We could also go out there and just take a look and say, okay, well, what's the MACD weekly look like on the ES? And we'll get rid of these moving averages for a moment, then we'll pop them back in. And then we just take a step back and go, well, here's the zero line. We hit the zero line in October and we bounced off of it. And we know how to connect the dots. We're already aware how to connect the dots, right? For those that are new, we'll walk through it so that we're all on the same page. But we know what happened here. This is where the Fed came out and said, we're not going to do what? We're not going to raise rates anymore. Okay, and then you can see how that ties in. So you can start to see real clear here how the macro may affect the technical side of the market, right? This is later and everyone's talking about the cross, but if you understood the macro leg, which is this, in my crude drawing, you would understand why that's important. And then it takes you into the next move. Well, what was that? That's when he said, well, next we're looking at cutting rates, 75 basis points this year. Now, we all saw what he looked like on the last conference call, and there's really no reason for us to go through that dumpster fire, but his messaging was not very clear. So we have a technical picture of what the ES looks like. Let's go through and just take a look at the NQ. There is very little, we're going to clear all this off. There is very little that I can say looking at the NQ on something like a MACD or rate of change or even on an RSI that is going to tell me or help you decipher what's going on here technically. There's not much that I can do there, right? You can see this, and this is significant. You rallied through, you retested the rally, and then you broke out. You can say anything you want, and you can go back to, and I want to be real clear about this because we're going to get into it today. I get asked a lot, how did you know that Meta was the one that was going to move the most? First, you never really know, but there's a way to tell. And I'm going to get into a little bit of my theory today on how I view the world on not only the macro side, but how I look to differentiate. And how I learned that this was significant was your comments. So please keep the comments coming. I do read them. I do try to respond to every single one. Might be a couple days late. But one of the things I did this, I think it was Wednesday or Thursday's video, is I actually showed one of the trades. And people were surprised at how that trade outshined some of the other trades and why. We're going to get into that today and telling you when you have edge and how to strike. This can be pretty significant. This is probably one of the more significant videos that I've made that talks about my trading and how you can start to mimic it. And you can start to develop it and make it your own, which is what you want, right? You don't want to be somebody's robot. It's got to be yours. If you don't make it yours, you're always going to be relying on somebody. You don't want to rely on anybody. So here's the NQ, and we talked about this head and shoulders. I think I got booze in the comments at one time. I said, well, this kind of looks like a cup and handle. I don't know. And people were like, that's not a cup and handle. It's got to be half of this. Look, I don't care if you call it a blueberry. There it is. You're looking right at it, okay? Here's your cup and handle. On the weekly, you broke out. This is where it gets goofy, and this is where people are going to come into the comments. You have to look at the upper channel to determine where you could get to. Okay, you have to look at the upper channel to determine where you could get to. There's your upper channel. So before you even come out there and say, well, we can't go any higher, that technically is how people would look at this. Now could be years away. I'm not saying you're getting there by Tuesday. What I'm saying to you is you have all this breathing room in the upper channel before you even have an issue. And it does respect the upper channel usually. Right? This is usually where you run into issues. You can see it here all through 20, through 22, 21. And so you can respect that, just like here you had one. So you always want to be cognizant of that. So if you look at this on the weekly, there's not much value that I'm going to add there. So we're not going to spend a lot of time on that. We're not going to spend a lot of time on non-farm payrolls. They're going to just revise it anyway. What the heck's the difference? So when we look at that, we have to understand, okay, well, this is what came out and this is how we acted. And then we look at something like this, RTY, why are we not moving up? Why are we not moving down? We have the banking issue. The banking issue is a real issue, and we should talk about that. Let's just get this out there so everybody knows this. 15.9% of the Russell 2000 is financial services names. They are the small cap names. They are your regional banks that look like dumpster fires right now. And that's something that we should spend a moment on here. Please be aware, this is an issue. This was something that I really liked and was very excited to own and bought when they were allowed to buy assets a year ago. Okay. I like the fact that FDIC said you can buy assets. Everybody wanted to buy these assets. And they said, New York Community Bank, you can buy the assets. And everyone said, that's great. Yay. And then the stock went up. What happened was they took their first loss that I can find. I went back 20 years randomly looking. They'd never taken a loss before. They just took one. So that means there's only one thing. These assets were toxic and they don't know, and they weren't aware of it, what they bought. They have a real problem here. And the banking system, in my opinion, has a problem. This shifted the focus. and we're going off on this one tangent before we get into this, but you need to understand this. This shifted the focus massively for me because this meant that banks like this are not going to lend money. And then so I look at REITs and say, they may be in more trouble than we think they are if people are not going to lend money. And so we may have a problem in the banking system. I don't want to overlook that. We had a very nice trade being short this the other day. Absolutely huge trade. I walked through it live when we did it in the room live, and I actually posted that live. And I'm going to start doing more of that, posting them live, showing actual timestamps of actually trades and showing some of the trades in a account that I keep that follows what we do in the community, and then showing how I am legging into those trades. But I see people out there going, oh, I'm going to, this is cheap, I'm going to buy this. First off, it's a 3X ETF. If you don't understand that these are calculated daily, and if you don't understand what calculated daily means, you need to look into it because you're expecting that you're going to bounce just back to here if the if KRE gets back to there. And that's not how it works. Okay? That's not how any of this works. There's a reason why when you look at the Qs, let's get rid of all this for a second because this is important. So I'm going to spend 1 minute on a deviation. See where the Qs are? See how the Qs are up here? Okay. There's TQQ. Why isn't TQQ here? Because of how these are calculated, right? They are calculated on a daily basis. It is a 3X ETF that just makes theta of an options look like kindergarten, okay? When you understand how these are calculated, you'll understand that just because KRE is going to bounce somewhere does not mean that DPST is going to bounce to the same place. Extremely important decision. That's why when people always say to me, why do you short the bull ETFs versus just buying the bear ETFs? This is why. This is one of the core reasons why, because of the deterioration of them and how they are calculated. Keep that in mind. Where am I going with this? I think there's an issue out there. I don't think we know what the issue is. I know people are going to speculate on the issue, and that what I know is this, and this is going to tie into later, and this is where I'm going with it. And I think this is a very important distinction, so please pay attention to this. You have right here what people's expectations are. These are what we have as expectations. This is what the outcome is going to be. The question is, who, from a bullish and a bearish perspective, who's right, who's wrong? Okay, we don't know yet, but I can tell you right now that the disparity between who's right and who's wrong is probably as significant as we've had in some time with regional banks. So for me, with regional banks and REITs, it was a no-brainer. I don't have enough data to say that we definitely have an issue or we don't have an issue. I don't know yet. And I don't think anybody does. People are going to pontificate. So when I don't know something, when in doubt, what do they say? Get out. Okay. And when you do think you know something and you have this kind of spread, act first, act fast. Huge difference. Now let's get into it. Now, a couple key things that we're going to talk about. This is stocks above the 50-day moving average. And I talked about risk on, risk off this week. This is S5FI. This is on TradingView. The 39 sector that I just showed you, you can pick up off of TradingView. If you follow me there, I think it's Arete 20706. If there is a way that I can put that out there for people just to pick that up so that they can do it themselves, please let me know. I also have it in a watch list. If there's a way that I can post watch lists so that they're public, I have no problem sharing some of this stuff. Some of it's proprietary. But this S5FI, if you look at it, we're off that 90 and look at how we dropped last week. Does that look like something that's going on? Does that make it feel like we're seeing that in the market right now? No. Okay. S5TH, S&P on the weekly. See where we are in the weekly. We're kind of backing off this key level. This is very important for us to understand when we're starting to look at stocks above the 20-day and where we are on a weekly chart. And why am I showing this? Because I want you to understand how middle of the road we really are. But when we start drilling into this on a 200-day, we're near the top end. If we start drilling into this on a 50-day, we're near the top end. So we did not have the broad-based number of stocks rallying last week. We had the opposite. And what's happening is you're narrowing and getting narrower. And as that continues, that can be an issue down the line. So I want to preface this as we're getting into this. You want to have the full picture, and you're going to see why in a minute. Now, I like looking at past performance for long periods of times, not just a year or two or a decade, but I like going back like 50, 60 years and going, okay, over this body of work, what happened? Now, there's a reason for this, human nature, and it's actually one of the reasons how I trade. But all these red dots, and now here's what I want to point out. This is not mine. This is Sediment Trader. I refer to them a lot because they do a lot of back testing and data, and then they analyze that, and then they put it out there. No affiliation with them. There's not even a link below. I just like their product. It goes from the 50s to date. What are we measuring? S&P 500 after 3-month gain of 15% or more. What's that mean? S&P goes up 15% in a 3-month period, not a 12-month period, in a 3-month period. So it's a big move in a short period of time, right? What that means is reversal of trend. We'll get into this later in today's video, but what this is telling you is that people were wrong. Whether you believed it or not, people were wrong. If they thought the market was going down, the market went up, and the people that thought the market was going to go sideways, they were wrong, and now you're seeing a panic. 3-month gain in 15% on the S&P is not normal. So I'm just going to say that again. A 15% gain on the S&P in 3 months, it's not normal. A matter of fact, these red dots represent every time that it happened. Every single one of these red dots represents a 3-month gain of 15% or more. So does that look like something that's happening a lot? No. A matter of fact, I think it's only happened somewhere around 23 or 24 times. But the data and what it suggests when this happens, now this is where it gets really interesting. So what they've done in this study is they've taken every data point and they've gone back to 1955, which was probably where their data set goes. That's kind of an interesting period in time, right? It's 10 years after World War II. And it takes you to today and what just happened. During this period of time, you will note what happens during the first week, the second week, first month, second, third, 6th, and 12 months. What's fascinating to me in just first glance looking at this data before we crunch the numbers, or actually they crunch the numbers, is this. And I just thought this was really neat. 1 year. So out of all the times that you've seen this happen, 12 months later, there's only once, 1987, the crash, that this has happened. Now, anything can happen, and we know that, right? We could be looking at this data 10 years from now, and we could say, oh, remember when we thought this? So we have to always be cognizant of what we're looking at, right? And we have to go and say, well, when was the greatest number that ever came out? Here. Well, we know why that's the greatest number, because they injected what? $1.7 trillion into the stock market. So there are nuances to this, but if you take it as a body of work and then you average it, figure out what the median is, look at the max and the min, you can actually come up with data that is workable. At least I think you can come up with data that is workable. Again, I like going off the data like this because it makes my life a little bit easier. It tells me what's happened in the past and how I can utilize that data to make more informed decisions now. Now, what you're going to see here is that it's telling us it was 22 signals. And then what it does up here is it marks what's happened in a week, 2 weeks, a month, 2, 3, 6, and 12. You get it. Then you have a median, you have the percentage positives, you have the average loss during that period in time, and you have the average max gain. So the average max loss, average max gain, and they give it a Z-score as well. All right. And then what they're doing is they tell you numbers are a percent return after the signal. Risk equals average max loss. Reward equals average max gain. Z-score plus or minus 2 suggests the significance. Okay, so they use a Z-score to determine the significance. Now, if we were to look at this, and this is what I find fascinating, it's 50% a week later, it's a coin toss. So that fits into what we were talking about the other day, where we're starting to look a little exhausted. Right? We're starting to look a little tired. Even I feel that way, and I like the earnings that are coming out. And no matter how you feel about the earnings, as of last week, before this week, 54% of all S&P stocks, 54% beat by 1 standard deviation. It's pretty big. So, this is where we are. This would be 1 standard deviation, 2 standard deviations, 3 standard deviations, and we beat on 54% by that much. So it's not a small amount. It's not a small beat. Where this gets fascinating to me, and I would rather have 30 data points because that's what you need to be optimally statistical, like statistical significance is how it's referred to. I don't have that. I can only go off what I have, right? But look what happens when you get to 3 months. Look what happens when you get to 6 or 12. Look what happens to this number. Like that's not a joke. Like 90% of the time, 91% of the time, 95% of the time, you're higher 12 months later. If you took any data point at any given time on the S&P and said, from this data point, are we higher or lower? It's not 95%. It's not even close. So that is pretty significant. Meaning any random data point, if you just took any random data point 22 times on a chart and just said 12 months later, are we higher or lower? It's not 95%. It's just not. So knowing that, there's an edge here. And that's how I view it. There's without a doubt 100% an edge here. And it's something that I'm certainly going to be paying attention to. The drawdown does not seem like it's a lot to me, candidly. What are you looking at? You're looking at a 3.5% max versus this. What are you looking at? Even if this was the average, you took the average, what are you looking at? 3 to 1, 6 to 1 if you do it from here? It's crazy. Now, what they do here is they take a snapshot of long SPX 12 months after. So just a snapshot of that particular time. They give you the start date and they give you the end date, right? And the end date's triggered by obviously the data switching, right? But they tell you how long it goes for. I thought this was amazing. From the date that it kicks in and they go out 12 months, 16 months, 13 months, 14 months, 23, 20, 14, 13, 12, right? No matter how you look at it, but this is what I thought was really neat. No matter what, the average, now you're going to be skewed and your average is going to be 14.4, but your median is really 13. And where this fits in is it kind of almost fits in with how my narrative on what I think is going on here. I think that they keep the economy chugging along. I think they keep it in great shape this year. And then I think that after the election, depending upon, it doesn't really matter who wins, I think next year could be a dumpster fire, right? Because there's a lot of baggage out here in the market. You have really high credit card debt. You have really high payments. There's a lot of issues out there, as we know, in the economy. But I think that stuff is being skewed, hidden, and basically trying to keep this afloat. But it does tie right into next year, right after an inauguration. And I just thought that was an interesting data point. Again, this is Sentiment Trader. And out of all these data points and all this time, 23 months, look at this, one time, negative 1%. And I guarantee in there, you were probably up at some point. So I thought that was fascinating. I like the average being 21%. This is your minimum. This is your median. Do with this what you want. But it does feed into the idea that, hey, maybe we're going to go sideways for like a week or two. But within going into the election, we could really see this market ramp up. And I know people find that very hard to believe. But yeah, you can actually have some kind of pullback, go sideways, and then ramp up again. It is quite possible. I would feel differently that we weren't in this kind of environment if we didn't just see the huge move that we had in the market, and also if earnings weren't crushing the way that they are. There are three distinct earnings that came out, and I want to talk about this because this is going to lead us to something that is really significant and going to help everybody with their trading. Number one, Apple comes out with earnings, breaks the 200-day moving average. People are looking to play this for a bounce. Was this optimal? The issue with this is two things. One, you don't know that you're going to get back over that 200-day moving average. You cracked and you took out the low of here. So there's a couple things that you could do here. And you can watch this off the open. Number one, you could say there is a huge support line, resistance, support right on that line. And there's the 200-day. And therefore, I'm going to get in there. My problem is slow sales. So this didn't make a lot of sense to me. And this new product is quite frankly a dumpster fire. They have to cheer for you when you leave with the product. This is not something I want to do. That is my belief, and we're going to talk about beliefs in a moment here and why that affected my judgment here. I had a trade on it, but as you'll see, I made very little money. I'm going to show you a couple of the trades today. Amazon, very simple to understand here, but let me drill this out. To me, when we opened, I'll show you exactly where we opened, and this is why even on good news, I was not too crazy about getting involved with this. And this was one of the key reasons why I did not go crazy on this name. I had a trade on it, but we opened right into a key resistance point. You always want to know where your support and resistance lines are and then watch how the players act there. And so we saw that. And that leads us to Meta. Now, Meta after hours, if you watched Thursday's video, you know we were hyper aggressive there. I showed some of the trades that we actually did after hours there and how you could do that. I'm going to walk you through why Meta was the one to play and why it was very obvious, or like, as I like to say, glaringly obvious that this was the one that you wanted to play. Now, in front of you are notes, and these notes are from, this note in particular is from Goldman. And this is from their research. Now, why is this important? This is important, and you're going to see in a moment. Stock opens up 17%. I want you to look at this question. Stock opens up 17%. They're on their desk, so this is a trading note in the middle of the day. Where can this go? Why is it up so much? Questions in the after hours. Very strong revenue quarter guides is above 6 to 7%. $50 billion buyback, 50-cent dividend. Why is this important? I'm going to show you why this is so important in a moment. But understand, look at the questions. Does that sound like institutions understand why the stock is up? No. What do you have? You have a disparity. We're going to explain disparities and why they're so significant and why you should smell blood in the water when you have something like that. But what you should really focus on this, okay? Significant revenue beat, guided well above earnings. This explains revenue growth beat. This is just Goldman saying this is where we were versus the street. Total expenses, despite more positive revenue outlook, year of efficiency, okay? Continues to drive operating leverage. Positive commentary on newer initiative, Reels, Daily Watch, year-over-year advantage, increasing advertiser adoption. What are they doing? What's going on here? They're speeding up the cash flow machine. Do you understand? They're speeding up the cash flow machine. Is there any talk in any of this of you're going to be a giraffe in the metaverse and we're all going to hang out and play volleyball and you're never going to have to leave your house and eat bonbons, right? There's none of that here. It's we have this, we have the eyeballs, we're going to drive the traffic, we're going to create tons of cash flow. Right? Do you see? Hopefully you'll notice that distinction here. Huge distinction. Continued shareholder returns with shareholder buybacks of 6.3, 20 billion for the year, an additional 50 billion for the year. And by the way, we're going to start giving you 50 cents a share. Okay. Why is this significant? You can see what's going on right in here as well. Same thing, key metrics, guidance. This is just from somebody else. So I went to post from another, I believe this was from JP Morgan. But what they're showing you here is the same thing. This is how they're looking at it. FTC seeking substantially modify consent order on Meta if its contesting is unsuccessful. This can impose restrictions. There's the issue. All right. CFO said company will discontinue reporting monthly and daily active users. Why are they going to discontinue this? They're no longer the growth company, guys. They're now the cash flow engine. This is a huge shift that people were not expecting. Why, again, is this shift important? In 2012, Apple, stay with me. In 2012, Apple, Steve Jobs dies, Tim Cook takes the reins. During that period in time, it is expected that Apple is no longer going to be a driving force. Larry Ellison comes out, sells his shares, never going to be the innovator again, no reason to own the stock. Other names will outperform it. He starts playing with Tesla, gets on the board eventually. Another story for another time. What does Tim Cook do? Well, it's obvious what Tim Cook does after a period of time. There is a talk that happens. During that talk, he has dinner, and this is rumored throughout Wall Street, but he has dinner with Carl Icahn. Carl Icahn walks him through, start doing shareholder buybacks, start buying back your own stock and start increasing the dividend. This will allow people to buy your stock. All right, so what happens here is they start that and they start buying, and you can see, and the rest is history. Why? Pension funds want to buy that, and they want to do that for one particular reason. That way they could put themselves in a position with their assumptions, and those assumptions allow them to go out and buy stock in the open market. The rest is history. Okay? Meta is following the Apple playbook. .com. This is the .com of Microsoft. This is where Ballmer gets out of the company after 15 years between Gates and Ballmer. And a new gentleman steps in, CEO. What is the first thing that the CEO starts doing? Increasing shareholder buyback. Following what? Apple playbook. He starts following the Apple playbook, starts shareholder buybacks. What does he start after that? Shareholder buybacks. Starts increasing the dividend. What else does he do? Start increasing the subscription model. Okay. So what has Meta done over the last 3 months? Started a subscription model where you pay. Okay. On certain parts of the platforms that he has, you pay. Just instituted a dividend. Starts throwing off cash, revving up the engine, okay? The cash flow engine, all right? It's the same playbook. This whole playbook started with IBM. People are looking at Meta right now and saying, what's going to happen? Why is everybody buying this? It's too high. I would suggest that you would take a moment and look at that and look at history, and you'll see where I'm going with this in a moment. All right, guys. So the best way that I can do is just walk through this. I'm trying something a little bit different with today's video. Clearly, some of the pre-market stuff I do, but I want to show you this trade, and I want to show you specifically how I entered this trade, because you're going to hear a lot when I show the live trade in a moment. But I want to get to why was this move so significant? And we walked through this in Thursday's video. Again, it was the dividend, expectations. And we're going to talk about expectations greatly here in a moment. Once we got involved here, once we were able to establish pulling money out of this, we were then able to find a more longer term position and stay in the trade. One of the things I did when you look at this trade, and I want you to get this concept, I get asked a lot about this trade. So in the room, you will see a trade where we are entering. If you're in the community, you'll see me do this a lot. I am entering at 8 p.m. I'm entering exactly at 8 p.m. on anything that's a monster. Now, people are going to say, well, why do you do that at 8 p.m.? I do that at 8 p.m. because Asia and when London opens, they don't have access to our markets. They don't have access at the same time, right? They're in a different time frame. They have different access dependent upon who they are. Do the big players have access? Of course. Big players have access to liquidity 24/7. Remember that. Big players have access to our liquidity 24/7. Retail, and then your levels of retail and your level of institution, not so much. So at 8 o'clock, this news hits. As it spreads overnight, you'll start seeing that 4 a.m. market. Now, if you have an Interactive Brokers account, you'll get access to the market 24/7. Interactive Brokers globally, they have access as well. And you'll see the players start stepping in here primarily to the Asian market right here at like 4 o'clock. All right. I'm walking you through this for a reason because it's really important to understand this. When does retail get involved? When does retail really get involved? 7 o'clock. So we have a trade, or I have a trade that we do in the room where we're buying something right at 8, right? And then right when toss opens and these other names, guess what you start seeing at 7 o'clock? Retail piling in, right? Because most of them are not looking at the market at 4 o'clock, listening to the conference calls, understanding where the money's flowing, looking for the divergences, looking for the nuances. They're not doing that, right? We are, okay? And so when you're getting in here, you're able to get involved here. Now, it's just not Meta. You can go look at Amazon, Apple, any of these names. And if it's positive news, okay, positive news, it will act positively, usually most of the time. It's greater than 50%. And then if you look at this, if it's negative, then you just take the negative side of the trade. But that is why we do these trades at 8 p.m. to 7 a.m. I'm actually answering this question for people in the room that keep asking this question. Now, if you take a look at Meta and you watch how the day plays out, I want people to understand this. So when I show you this here, P&L, hold on, let me show you this in a moment. All right, so I'm not a big fan of showing these P&Ls. I'm doing it because people are saying, oh, well, that's what you do. That's how you get your returns, or that's when you go pretty heavy. And yeah, there's some methodology to that. So I think that it's going to benefit people from doing this. Now, I also want to show win ratios so people get it, because it's not a question of win ratio. If you find value in this, if you can do me a favor, if you can comment on it below, because it helps me understand. When I started showing this on Thursday, the questions I got about position size, why this one was outsized, things like that, it actually showed me why I'm missing a part of this, and actually is one of the reasons why this next part of the video is going to be so important. But this meta trade right here, where we pulled out like 40, what's important about this is that, one, this is not how I trade all my accounts. Just be very clear about that. This account is a very aggressive account that I trade, and I actually link it to the ideas that I put in the Alpha Chasers community, so I can watch them and see how people are doing. And you'll see, like, yep, we pulled money out of NVIDIA, pulled some money out of SMCI. That was a really cool trade that I should walk through because I did it with puts and then buying stock against the puts. And I should get into that. It is a really cool lesson there. I do those in the educational class in the lessons, but I should do a public video of it. But you're going to see this number, right? Well, it's really important to understand where that 40 came from so people can get this. So first, understand that that trade was a partial trade from here and then allowing this to trade up and sell into it, okay? So all I had was overnight risk, right? Then we do another trade in here where the rest of it comes from. And that comes in right there, right when we flip that doji. Now I'm going to show you that live. All right, let's get to it. So they're just ripping it right off the open. Let's just watch this. I at least want a bar to form before I get involved, and then I'll go from there. This is what we're looking for, meta. So we start legging in here, and then we use that doji because they're going to rip it if they rip it. All right, I'm buying some. So I bought some meta there, added more meta. I don't know how long I'll be at it. I'll tell you in a moment. What are we up $1? Trimmed some meta, up $2, trimmed more meta, up 3, trimmed more meta. All right, leaving the rest as the low for that bar. And now I'm going to try to build a position around. I want to leave the rest on for now, and I want to add to it. But I wanted to pull something out because I get to that open and then reject. So that's what we want to watch and go from there. All right, follow me? So all we did was wait for the doji, watch our level right here, which was our anchored VWAP, and here we go. Do I get to this level? Do I reverse? I don't have an answer to that yet, but we bought right. So now we're just going to watch it. All right, we'll hold the rest and we'll go from there. All right. Nothing to do. Do want to own this name. Yep, we're going to start that nonsense already, right? Let me just see here if you're going to push or no. Out, half, $4, gain, down to 20% of the position. I could be wrong here. They could just push it, and then I got to play catch up later, but that's okay. I did really well overnight with it, but I got to be really careful here. That is the focal point for me today. So you're at a little bit of a crossroads, but you're holding that open, which means that you probably have buyers out there, right? So that might mean that we're going to put this all back on in a minute here. Let's watch. Especially if you give me that bar, I can work off that bar. Yep, I'm in. So I have that position back on, and let's see. Good. All right, up $1, pulled something out. All right, so I'm back to that full position. Good, up $2, leaving the rest on. Let's see what happens. Okay. So now you've watched how we've entered that live. You've watched why we've done this trade. You've watched us, how we're pulling money out of that trade. Let's clean all this off, and why I think this trade is so significant. If you find value in how I'm doing this and how I'm explaining it, because this took a while to put together, if you can comment below those steps and what you found valuable, I think it'd be really valuable the more that I'm getting questions to show, hey, this is what January looked like, and this is what the win ratio was in January, and these were my losses, and this is how I took losses, right? I think that that would be really helpful. But what's really going to be important is for you to understand the methodology on why I'm doing what I'm doing and how I refer to it as smelling blood in the water. So watch this. Now, we talk a lot about the stool, and we talk a lot about the macro, we talk about the fundamentals, and we talk about the technicals, right? Those three legs of the stool. And that is very important, obviously. One of the parts of the fundamental side of the argument is understanding when something is important or when something is not important. And I hear a lot, well, how do you know that Meta is important? How did you know it was more important than what happened at Amazon? Or how do you know that this is the one that's going to move versus how do you know that this one is not going to move as much? The reason that you can know that or how you learn that is relatively simple. This is a concept. It's called reflexivity. And really what you're going to want to learn is the varying levels of reflexivity. And I'm going to try to explain this common sense wise. So here you have the actual outcome up here. Here you have what everybody expects to have happen. And here's the outcome of what happens. In between this, the participants that are watching this actually affect this. And so what you have is you're going to have some differentiation in here. And that differentiation is going to just kind of bounce around, right? But the difference between what happens in here versus what we think is going to happen is why you get the movement that you get. And that's a very important concept. So what you think is going to happen, meaning not just you, but the general populace, what they think is going to happen versus what actually happens. That is the difference in what determines the move. That is why when something has earnings and the earnings are so great and so off, the stock moves. It's got very little to do with the price earnings multiple. It has very little to do with anything else except expectations. What did the masses think we were going to get and what did we actually get? That's the difference. Also, how people are looking at that situation, meaning let's say that you have a situation where you had NVIDIA and NVIDIA comes out with earnings. Let's take a look at NVIDIA for a second. Showing NVIDIA would be an excellent example of this, and then we'll get into it and we'll spend a little more time on it. But this is a really important concept because I get it a lot, especially when we did the meta trade and we were very active on the meta trade for 2 days last evening, and then this on Friday. This is being recorded on Friday night. And we were very active here. We were very active in AVGO when this happened as well. There's a reason for this, and I'm going to explain what those reasons are. But here you have a certain set of people that think that they're going to beat expectation. Those people could be the people that bought here. So you have a set of people that have a belief, right? And their belief here was that, oh, we had a good quarter. I expect us to have another good quarter, and I expect the stock will go higher because of that. And then you have a whole litany of people that are saying, well, we don't expect that to be the case. We don't expect it to beat earnings. And so what you do is you get a whole other group of people that feel one way about the stock. Now, what that starts to happen here is those that really liked NVIDIA here are going to have that movement, right? And they're going to be involved here. And the people that liked NVIDIA here are going to be different than the people that like NVIDIA here. Please just stay with me. I'll show it to you in lines. So you have a line right here. These are the people that thought here that they really liked NVIDIA's next quarter. The people that after this quarter that liked it, this was the outcome, okay? So the people that liked it from here to here, this was their outcome, okay? This is their outcome. The people that liked it after this, this is their outcome. What's the difference? The difference is when people are identifying the positive move and the possibility that everybody is wrong. So if you think about reflexivity, think about it this way. It's basically you're betting that everybody else is wrong. People would say, oh, it's contrarian. Yes and no. It's not contrarian. It's that something happens that is different than what people have perceived is going to happen. And it also is based upon the way that we are viewing the event. Think of how many people when this happened right here. Think of how many people at this level right here said it was a fake, it's a fad, it's going to fade, it's going to do this, it's going to do that. They had expectations of what was going to happen here. Now, think about here in this break and think about the amount of people that bought into there. So what you have now is you have a differentiation of people here that were on board, people here that were on board, and people here on that break that are on board. So if this is the outcome, what's happening is these lines. And so whoever is in first for the first part of the reflexivity, meaning the differentiation between what everyone expects to happen versus what happens, and then at the same time, the amount of people are now observing the activity. When this starts to happen, what transpires, right? The greatest move. Well, when was the greatest move? Well, right here, because these people saw it. Was this the greatest move? No. Everybody now knows that NVIDIA makes AI chips. Everybody now knows that this is a dominant business. You'd have to be living under a rock now to know this now. It doesn't mean that it doesn't work, but these people make the most amount of money on the trade. And that's the concept of reflexivity. So let's just walk through this because I want to give you another example how you can even have micro reflexivity events. And that would be a really good example of and not just a major shift in someone's business, a fundamental shift, but it would be in something else too, where it could be not a technical, but could be something on the macro side, right? So let's just walk through it now. So now you have an example, so you know where I'm going with this, and that might help you deal with the language that we're about to go through. So the principle here of reflexivity is a feedback loop between what the human investors think about reality, meaning AI is a fad, it's going to fade. What do the humans think, i.e. us, okay? And that reality itself. So what do humans think about the reality versus what is actually real, okay? There's a difference. That was the disparity that we just showed. That's why I wanted to take a moment and give you an example so that you can kind of link this language to that. For instance, when investors are optimistic about the economy, think about now, we're expecting rate cuts. We're not getting rate cuts. We're not getting rate cuts because the economy is better than we think it is, apparently. Let's just leave it at that. So they might start to buy stocks, anticipating that the economic growth will translate to nice profits. That buying then pushes stock prices up and boosts the value of the companies today. Make sense? Okay. That in turn leads companies to invest more in projects, which can in turn boost consumption and profits. Those improvements then can increase investors' confidence in the economy. Self-fulfilling prophecy. Get it? Leading them to be even more optimistic and continuing the cycle of self-reinforcing pattern. Put more simply, the expectation of a good environment can create a good environment, but also a good environment can then change people's opinion here. So let's dig more into this. At any given moment, different investors will have different biased views. And we see this all day long. People saying NVIDIA is a scam. NVIDIA is going to be the greatest company in the world, right? We have all these differentiating opinions. Those biased views, what you want to understand with those biased views or biased opinions about what's going to happen on an earnings call, that differentiation, the more bias, the greater the reflex move, the greater the move. The more bias on either side, the greater the move. All right. That's just the way that it is. And understand that. And then when someone starts to realize, like these people might realize they're wrong, these people might realize that they're right, but that, maybe they're not as right as they thought they were. And so this starts to happen. And so the expectation of those moves comes down. Strike first, strike fast. Okay. Think of it that way. Based on reality. And so different feedback loops will be at work, right? You'll have the negative NVIDIA side, the positive NVIDIA side, right? You have the people that thought Meta was going to come out and talk about how we were all going to be giraffes in the metaverse. Okay, we were all going to talk to Zuck with our giraffe heads and rhinoceros heads. Instead, he turns the company into a cash cow. Okay. Now you might not think that's a cash cow, but I'm going to give you examples of how this is played back in the past and why you really need to pay attention to Meta and why I'm spending so much time on it. But this concept, if you grab this concept, this is worth its weight in gold. This is something in this video that you should watch over and over again, because when you get this concept, you can apply it to your trading. And this gives you an edge. That creates the irregular price movements that will be used in seeing in the markets. Sometimes, however, one set of beliefs will start to dominate. Everybody thinks AI, is going to be great. When combined with those self-reinforcing loop patterns, meaning what we just saw earlier when they were talking about the loops. Hey, everybody's buying. So AI is just, they're expanding their chips. They're expanding their factories. More chips for everybody, right? They can then produce and substantially persist to deviate from what is considered fair value. AMD at a $1,500 PE or 15 PE, where people think PE moves stock, and they're saying, well, this isn't fair value. Okay, there's another example. But nothing lasts forever. Eventually, the divergence will become too extreme. There will hit a point where NVIDIA just gets way ahead of itself, okay? And that divergence, when it happens, it will come back down. Boom and bust cycles. There is no equilibrium. It's a myth. And if you can't understand my investment philosophy, it's that wrapped up. The efficient market theory is a bunch of nonsense. Investors' perception of reality will start to change, and the feedback loop will start to move in the opposite direction. Boom, bust. Okay, think the real estate market in 2007, 2008. Now, there are two ways to utilize this. Right? The first is to bet on a feedback loop themselves and try to ride the momentum or assets that are most exposed to them. The trend is your friend, right? So instead of saying AI is too expensive, AI is a fad, who cares? That's not your job. Your job is not to write an article. Okay, your job is not to pontificate from a mountain somewhere or a beach and meditate on it. Your job is to make money as a trader, right? So if that's your job and AI stocks are going higher, why not just buy AI stocks? If everybody wants to buy, Beanie Babies, why not buy Beanie Babies? Why say this is a fad and it's going to go away? Just go out there and buy NFTs. Just be the last person, don't be the last person holding that NFT, because eventually it will crash, right? And now you just own this JPEG. So the first is to bet on the feedback loops themselves. I would strongly suggest that this is the way that most people should go. For instance, you could buy tech stocks on the basis that they are likely to benefit heavily from the development of artificial intelligence, and they are perceived to be more defensive than any other cyclical cycles. You could also follow trend following strategy, buying assets that are seeing the most positive momentum and shorting the ones seeing the most negative momentum. You could also follow a trend following strategy. The trend is your friend. Buy assets that people are buying. Sell assets that people are selling. It's not rocket science, but that's reflexivity. Or you can try to anticipate when a new narrative is going to emerge. This is important because this is meta. This is why I was so adamant about the meta trade, and I'm going to give you 2 examples. When you understand these narratives and you understand what's happening here and you understand how they're changing, the narrative is changing, gain steam, a strategy explained. Okay, this is from an article in FinTech. They did a great job actually explaining it. So I'm going to show you a book at the end of this that you can actually buy. I have no affiliation with it, but you can actually buy this book and I would strongly suggest you read this book. The second is to try to identify when a trend may be exhausted, right? AI is going to crash. Okay, well, why do you feel that way? How many people feel that way, right? Where are we in that order that people feel that way? In other words, let's say that you think the secondary part of this, let's say you think the trend's going to be exhausted. Okay, it's your job to understand the disparity, right? And say, is all of retail involved, right? Or is this the reflexivity that we are? Is this where everybody is watching what's happening versus the outcome, or is everybody up here? Because if everybody's up here, then that's where you're at. For example, Thanksgiving dinner 5 years ago, when everybody was talking about Bitcoin at the Thanksgiving dinner, it was 5 or 6 years ago, you were up here. When you had your aunts and uncles and cousins, everyone had to buy Bitcoin. And then what happened to Bitcoin? That was the end of it. Because why? There was nobody left. Boom and bust cycles. All right. So if you're trying to determine when the exhaustion is going to kick in, and this is the one I always have the hardest time with, the exhaustion, because if you're early, you're going to miss it. You're going to just jump in front of it. You want to know when it's exhausted. Okay, that's really what you want to focus on. Bet on the inevitable reversal. All reversals, all these are boom and bust cycles. That's just the way it is. You try to identify the assets that have benefited the most from the positive feedback loop, and you bet against them. All right. A great example of this is 2001. If you go look at a book by Sir John Templeton, he made $100 million shorting all of the tech names in 01, because he's like, okay, this is the feedback loop. Everybody's in .com. Everyone's got a .com after them. None of them make money. We changed the metrics. He saw the writing on the wall, and he started shorting them in 2001. At the end of the year, he was up $100 million on one trade just by shorting the ones that were up the most. Crazy, but it was really that simple. Make sure you're not overexposed to them. Be cautious. So this is from a book by George Soros. Soros himself warned the directions or reversals are predictable. Soros himself warned that while the direction and the reversals are predictable, the timing and magnitude aren't. And this is really the rub. I'm usually early, and the magnitude of how crazy things can get, you have no idea. When people thought 2020 was crazy, they have no idea what .com was like. .com was literally 3 or 4x that. Or you can buy assets that are most likely to be trading at a discount to their fundamental value, as we explain here. And there's another article, discount to trading at their fundamental value. So this is a great way to look at reflexivity. This is a trade that I like to do, and I'll just give you an example of it here. And then I want to show you why meta is so important. Now, this is a great example. This is 22, and everybody is predicting that we're going to see a huge housing decline because of the amount of rates, right? So everybody is saying that rates are going up too much and the home builders have to come in. So everyone thinks that the home builders are going to drop, right? And they think for 23, it's going to be an awful year for the home builders. What people failed to realize is that we were short 6 million homes, okay? And they just were not building because they just weren't set up. Nonetheless, we got to a point where companies like Toll Brothers were trading at 80 cents on the dollar. That's where they were here, around 80 cents on the dollar. So what we did in our community with this trade was this. We knew this. And what we did was we knew the what. Okay, so we know the what we're looking at. Okay, what we're doing is we're looking for the when. So this got over our 55 right here. And this was something that we bought in the community and we did quite well with. Now, the differentiation here, why did this trade work so well? Because everybody was here waiting for the end of the world and they didn't understand the fundamental analysis behind it. So this is your level of outcome that we were expecting, that people were still going to buy houses. And the majority of people were here and they were expecting what? No one was ever going to buy a house again. I'm giving you hyperbole, but now you can understand the difference between these levels, right? And then how that's going to play out, okay? And that's really important to understand. So that's one level. Next, as we trade up And now we start saying they're going to stop cutting rates or they're going to stop raising rates. Well, that's right here, right? Well, we all realize that now. And then what's it do? It expands up to here when we realize that. So no one expected him to say what? That they were going to stop raising rates. A lot of people did, but what was the level of reflexivity from there? Okay, so if you understand that and then what happened in December, you can see the move. Now from here, how much reflexivity do you have now that we know that they're not going to cut anytime soon, right? So now the level of reflexivity of this move is here. You don't have the book value behind you, right? So you don't have the valuation behind you. Everybody knows that eventually they're going to cut rates and they're not going to raise rates. So now the reflexivity of a move like this is here. So is there really any real money to make here as there was back here? And the short answer is no. Okay, so now that's going to segue into, you're going to say how you're segueing into meta with this, with your home builder trade that you did, in 22 and 23. In 2012, Steve Jobs dies. When Steve Jobs dies, Tim Cook takes over right at this level. I'm going to mark it off both ways that way. So you're marked right here, okay? So this is when Tim Cook takes over. When Tim Cook takes over, Larry Ellison comes out and says, that is the end of Apple. I'm getting out of Apple. Apple will never have the innovation. The stock will never be what it once was. It's up 1,100% from there, okay? It's up 1,100% from this period in time. Now, what transpired? Steve Jobs passes, Tim Cook's in charge. Nobody thinks the company's going to do anything. So what do you have? You have people thinking the company's dead versus the actual outcome. And this disparity right here is the difference, okay? And as time went along, people like Tim Cook, what is the disparity now between where you're at now and understanding his financial engineering, okay? Now that you understand the financial engineering went back here, there's a famous meeting that happened with Tim Cook and Carl Icahn, where Carl Icahn explains to him and says, the innovation part of this is over. You need to start buying back your stock and you need to start issuing a dividend and increasing the dividend and buying your stock back. People will like that. You create a cash cow. You're going to get institutional sponsorship. They're going to know that they can rely on you. They're going to get the dividend. You're going to buy back the shares, meaning you're going to have a constant flow of just steady goes like this. And you become the next IBM. Right? Okay. So that's what happened with Apple. Now, when that happened, what we expected to happen versus the outcome were two different things. Now, here's another example of this so you can understand how significant this actually is. This is Microsoft. Now, if we go back and take a look at Microsoft and we mark this level right here, you will see that it peaked in 2000. It never came back to 2016. During this period of time, and we're going to zoom in like this, during this period of time, you had another little peak right here. What happened right here? Well, Steve Ballmer retired, and when Steve Ballmer retired, right in here, okay? Well, it was like, I think it was March or April 2014. Steve Ballmer retires. New CEO comes into play. What is the first thing the CEO does? Increase the dividend. Second thing he does, increase buybacks. Okay? Increases the dividend, increase buybacks. Starts subscription models. Starts getting revenue to come in off of Office. Takes that money that comes in, what's he do? Buybacks and dividends. What happens to the stock? Where did they all get this model from? Now, when this guy took over as CEO, what were the expectations? Okay, Steve Ballmer's out. Oh, we're just going to put this guy in to just run this stodgy ship. Tim Cook's in. Okay, so you have a CEO change. It's not the CEO change that's the issue. It's the fact that they started buying their own stock back, started increasing the dividend, and started a dividend, right? Okay, so understand that. Now, if we take a look at that, and we can go back and go, where did this whole model start? Whole model started from IBM. When IBM got to a point over time where they were no longer innovating, you know what they did? Buybacks and dividends. Okay, that's where the model actually comes from, IBM. Now, you take a look at Meta. And the great thing about reflexivity, I'm going to show you in a minute here. People will look at this. It's too high. It can't keep going. It can't keep doing this. Okay, they're doing buybacks. He just instituted a dividend. This is exactly what Microsoft has done. This is exactly what Apple has done. I am not the only person that understands this. Okay? I'm not. Right? Every institutional investor out there has somebody in their Rolodex, yes, I still say Rolodex, that works for them in their bullpen, however you want to refer to it, that does this kind of analysis that I just walked you guys through. So they're all looking at this and going, well, this is what Apple did. This is what Microsoft did. This is what you do. You get institutional sponsorship. You get value investors. You get pension funds that can buy your stock. Why? Because they can look at the dividend, okay, and then they can adjust their assumptions based upon the dividend because pension funds go off of assumptions. So if they can rely on that dividend, then pension funds can buy your stock because then they don't have to worry about their assumptions as much. They don't go off of their returns as much as the assumption. When they go over, they change. Different video, different time. So that's why this is moving the way it is. That's why it's so volatile. Now, the beautiful thing about this is in the comments, people are going to disagree with me. And when they disagree with me, what is that going to do? That is going to create what? Reflexivity, right? They're not going to believe it. Now, maybe I'm wrong. And maybe I'm the one that's wrong. And so what's going to happen until people get up here? That's why you strike what? And you strike fast, period. That's why I'm spending time on this. That's why I was so adamant about that trade in Thursday night's video. That's why I was so adamant in just showing how the P&L worked in the community. That's why I'm so adamant in showing you the trade right now, because people are asking when they're looking at the position size that I'm taking on things like this, they're saying, well, how do you know that that's the one? This is how I know that's the one. And this is the same framework that you can use in your own analysis to start learning how to do this. It's not very difficult, but you need to understand the concept. This is the name of the book. I don't care about the guy's politics. The book was written in the 80s. Vlocker wrote the foreword of this one. There's another one called Soros on Soros. That specific book, the foreword was written by Paul Tudor Jones. So if you want to pick it up. If not, but this is something that you should probably watch a couple times. Now, here's another example. My belief on Apple was that it was going to gap below the 200, below support, and then it rips. When it rips, I do a trade. The trade that I do is very small in comparison. That small in comparison trade, what happens? It actually pushes higher. So my belief system and my outcome and what I thought was going to happen is that we're going to run into the 200-day. I thought the outcome would be different based upon poor results. Other people didn't feel that way, and you can see the differentiation between what I thought was going to happen versus what happened, right? This is an example of what we just went over, reflexivity, an example of me not understanding it. Okay? And it's an important distinction because when you look at it and you can start utilizing it that way, you can start making more informed decisions. I hope this was helpful. Please comment below. It helps me create this content and how to best inform and educate.